to revisit it and also maybe even share it with our customers if we see great value in it, so that they can also have a great conversation with Mr. Jim. So Jim Mammarella, I was introduced to Jim, and I'll let him speak on his company, by Al Donahue. And Al does some work with Jim in his financial planning, as well as Jim has some other multiple market center owners inside KW that he works with. So this is absolutely a gift that Jim will spend his time with us and be a resource for all of us to understand how we make our money create wealth and not just work for that paycheck. We need to set ourselves up so that we have legacies to leave, that we are changing our generational wealth, conversations, and that we actually feel empowered to do something with that money and to build a better life for all of ourselves. So nothing better than to talk some finance with Jim Mammarella. Jim, go ahead, introduce yourself and tell us what your company is.
Thanks, Marybeth. I really appreciate it.
Yeah.
Let me share my screen.
Okay, let me give you some power here. Hold on a second. All right, poof, I gave it to you.
Perfect, thank you. All right, let me.
And Dave, you go get that listing, Dave.
Can everybody see that?
Yep, we got it.
Perfect. So what I'd like to do today is just tell you a little bit about my background, what I do for my clients, and then I'm going to share a very general strategic allocation model. So just a little bit about myself. I went to Widener University for finance and economics. Right out of school about 29 years ago, which I can't really believe, but I started in the finance world. I am a certified financial planner. I am also a registered investment advisor, which means that I have a fiduciary responsibility to my clients. I have a very extensive background in traditional financial planning. That being said, I do not use traditional financial planning with my clients. My firm, what we do is we are what I would call a macro.
Uh-oh.
He's a macro manager.
We got that.
I bet you he's gonna say that.
Uh-huh.
Jim,
you may even have mortgage brokers.
We froze a little bit, and where we
Can you hear me okay?
Where we last heard you was that you are a macro,
And that's it.
and I bet you it was manager. And I think he froze again, but he'll be all right. Jim. Thank you, Kevin Clark. Yeah, if you have some questions, go ahead and put it in the chat so that when Jim comes back.
I think my internet might be having some issues here.
Thanks, Jim. Yep. Are you back?
Nope.
Jim, I see you now. Go ahead. Nope, froze again.
So we are.
Oh,
Okay, here we go. Go ahead, Jim.
Yeah, sorry, something must have happened with the internet.
Okay.
Can you hear me now?
Yeah, we can hear you pretty clearly right now. Uh-huh.
Perfect. Not sure what happened, but.
oh, God. Uh-oh.
Okay, perfect. So you may have all these other advisors, and what I would say to you is they're probably doing a great job for you. They're trying to give you the best advice as possible. Yep. But has anybody
Jim?
It takes his breath away.
He takes my breath away too. Jim. Jim and I had a conversation with my husband as well, and he kind of went through this slide, and it was pretty enlightening to see that we have all of these people that interact and help us make our financial decisions: tax advisor, real estate agent, banker, life and health agent, legal advisor, money manager, auto, home insurance, business partner. Home and auto insurance is crazy because okay, now I see Kira on the here, is that you have all of these people that are touching your money, but they don't necessarily all talk to each other. So when you have someone that oversees the accounts and can have the conversation with you about all aspects finance in your life, and how insurance would affect you, how liabilities, how different types of SEP versus Roth IRA versus different asset type of investments for different types of investing opportunities, for different ideas for the specific client. But if you had someone who kind of, I guess, his macro manager overseeing all of those conversations so that you're moving the ship in the right direction. It's not where one product is actually working against the other product. And we see a lot of that in for some people that have some, let's say, life insurance investment policies. Currently, I'm getting out of one right now because that there was creating an investment opportunity. It was an investment vehicle, and yet it's a life insurance policy. So the life insurance should cost peanuts, where the investment aspect should be growing something much bigger than what it would be inside of an investment, an insurance policy. However, I am not the one to be asking all these questions. So hopefully Jim is coming back. Kevin, what was your question? Could you discuss qualified plans versus non-qualified? What do you mean by that?
Those are plans for retirement accounts, and there are certain procedures, certain things you have to hit in order to qualify for one. And one of them, the qualified plan, is where you are tax deferred. So the money you put in now, you don't have to pay on it until you start taking the money out, which could be 10, 15, 20 years from now. And you take the tax write-off. So if I invested, let's say, $25,000 this year in that non-qualified or qualified plan, I should say, I could take that as a write-off. So I'd save the money on that. And
Right.
most of us in our tax brackets, it's 30% or more,
So, I mean, Kev,
I want some expertise on that.
yeah. So to that conversation, I think it also depends on what time of life you're in too.
Yep.
Like, when are you going to actually touch that money? Is it better for you to just go ahead and pay the taxes on it now? Like, let's just say it's an account where I'd rather pay the taxes on it now, something set up for my son who's 10 years old, and he's not going to touch it till he's in his 50s, right? So for 40 years, I'll pay the taxes on it now because it's small, so that when I go in, it now it's way bigger, I'm not going to be taxed on it later on. Whereas if I start something now, to your other point, is it's tax deferred, and 40 years from now he goes to touch it, it's $2 million, and he's paying the tax on 2 million instead of what we were putting in it every year in the first 10 years.
Yep.
So
Yeah, these are the questions. This
Yeah.
is exactly why we're discussing it.
Exactly, because then that brings you into, like, it's a math problem. And he's coming back, he's just getting his internet fixed, but it's a math problem. Like, okay, how long am I going to be holding this for? And if it's going to eat away X amount every single, or do I pay it in the big chunk at the end when I go to take out the money, and I'll just pay the taxes then? Or
Right.
am I going to pay taxes this year? Do I want to take the write-off?
Right. And the other way somebody put it was, isn't it better for me to pay the taxes on the seeds that are growing this investment? Now pay on the seeds, or do I want to pay on the big forest that it makes in 20 years?
Right.
So, but when I said that to another financial planner, they're very good, these guys I said it to, they said, absolutely not. We've heard that story before, and they had a whole different opinion about it. So that's why I'm kind of confused.
So in their opinion was what? Pay it on the big instead of the seeds?
Correct. Yes.
Pay it on the forest.
Yes. Yeah.
So I guess maybe at that point, when you go to pay it on the forest, maybe you're in a different position, and you could use different assets to hit against it, and maybe find some other creative way to get out of the tax ramification.
Yep. Yep, it's all part
Well,
of the question. That's why I was looking forward to having this.
yeah, he'll
Uh,
be back. Don't worry, he's coming. He's brilliant. He's brilliant. My husband and I had an hour with him. But it does bring up these questions. And here's something that I went into the conversation with, and he's coming in now. It is never too early to start, guys. So some of these conversations, Kevin and I are talking, and you might say, this sounds a little advanced for me. I don't have that much money maybe to put in some of these vehicles. There's never too late of a time to start. There's never too early of a time to start. It just depends on what your strategy and what your goals are. And then talking to somebody like Jim, you can create a plan to make sure that you're going to hit your goal of your retirement in
Yeah.
20, 30 years, or maybe it's 10, maybe it's 50. Who
But
knows?
Marybeth, there is a time to start, and that time is now,
Yeah,
because the younger you are when you buy, let's say, life insurance, the cheaper it will always be.
that's right.
And I'm sure Jim will talk more about that. And as a matter of fact, we're looking at putting investments in for our grandkids. Not a lot of money, just, a couple $1,000s.
Yep.
Because now is a time, to do it, because it always be cheaper and will have a lot of time to grow.
Thank you.
Jim,
Thank you.
frozen? He's frozen. Okay.
I hope Jim's not frozen. Jim, are you frozen? No, Jim's there.
He's there. Smile.
Sorry, Comcast is doing something out in the street and they're screwing up our internet.
That's okay. All right. So Kevin and I just bought us some time. We were just talking about the difference between qualified plans and non-qualified plans. And I was just saying that it starts with just knowing what the goal is for the customer as well, so that you can help them decide what's better for them.
Yeah, and we're definitely going to get into that.
Sure.
I'll talk fast.
Okay, go ahead.
Oh, just when he's,
All right, perfect.
Now he's
Can
good,
everybody see
Kev.
this okay?
yeah, no.
It's coming. There we
Yeah.
are.
Yep. So typically, a little bit who we work with. Typically, we work with real estate investors and entrepreneurs. I'll be the first to tell you that I'm not a good fit for everybody. Primarily, we tend to think we're entrepreneurs ourselves. We tend to think along those lines, building passive income streams. And we believe that, things such as businesses, private equity, real estate is really what builds your wealth. Traditional financial planning uses what I would call a silo approach. And what I mean by that is they have these different buckets. They might have a bucket for an emergency, a bucket for college, a retirement bucket, maybe even a bucket for a second home. And their money is kind of sitting stagnant in one place. We use something called a strategy approach. And really your money is constantly moving, makes it easier to protect your wealth. We use something called the velocity of money, gives you greater flexibility and liquidity. Has anybody ever heard of the velocity of money, by the way?
Yes.
Great. And what is your understanding of it?
If it's the one I'm thinking about, is that the private banking concept, or is that something different?
It's similar, because that's what banks actually use. So when we use the term, we are talking about, really what banks do. And that is that if I put my money in a bank, they lend it out. And let's say they lend it to my neighbor, and my neighbor does home improvements, and they write the contractor a check for the home improvements. What do the contractors do with all their deposits at the end of the night? They put them back in the bank. So the bank gets this money, they lend it out again, they get it back, they lend it out. So they're using a dollar over and over and over again. To be fair, banks have something called a reserve requirement, which means that they have to keep a small percentage of those deposits in the bank. But what we try and teach our clients is how to use a dollar multiple times as opposed to just once. By the way, can everybody hear me okay?
So far.
Perfect. We use something called a financial model. So think of it as like a game board. If anybody plays chess or checkers, it's impossible to play without a game board. We view financial decisions in the same way. This is an economic model that was developed in the 1980s, and it has remained unchanged since that time. Everywhere you can put your money in the United States is represented on this model. I'm going to talk a little bit more about it. It's broken down into 3 areas: protection, savings, and growth. Protection area, we have things such as our car insurance, homeowners insurance, government programs, but we also have things such as wills, trusts, ownership arrangements, LLC operating agreements, things of that nature. And the cornerstone, which is life insurance. Savings components, we have things such as credit unions, money markets. Tax deductible would be things like IRAs, 401ks, tax-free 529 plans, Roths, tax deferred, cash value of life insurance, annuities. And then finally, the growth component, which would be bonds, stocks, options, traditional securities, but also hard assets, things such as collectibles, real estate, businesses tax shelter, private equity, oil and gas partnerships. If you look, these are arranged in a certain way, and depending on where they are, there's different levels. So bonds, for example, would protect your income. Stocks, like a preferred stock, I buy a preferred stock, it might appreciate, that's growth. In addition, it kicks off dividends, that's income. And the third level would be income, growth, and tax benefits. For example, I may buy a rental property. I should get positive cash flow from that property. That would be income. Ideally, that property will appreciate or give me growth. In addition, I could depreciate that property, write off various expenses, that's tax benefits. Everybody with me so far?
Yes, I am.
Perfect. We also look at your cash flow and debt management, which is very important. So what I'm going to do is just go over a general way in which you should allocate your money. The first rule that we have is full replacement protection of your assets. If you think back in feudal times, what was their wealth? Anybody? Like back when they had knights and castles? So they had gold and artwork, and they kept them inside the castle. And what did you always see around a castle?
A moat.
Moat.
Exactly, a moat. And the moat was to protect all their wealth from the marauders. Well, we believe in the same thing, building a moat around your castle. The marauders are more like attorneys, lawsuits, and the biggest marauder of them all, the IRS.
IRS, of course.
So rule number 1, we want to see you save a minimum of 15% of your gross annual income. Does anybody know where that 15% comes from?
Off the top.
Yeah. So if you're making 300,000, we want to see you saving 45,000 a year.
That's right.
Has anybody ever flown out west? California, anything like that?
Yes.
And how long did it take you?
3 hours, 4 hours.
5
You
hours?
normally, if you're going to California, maybe 5 hours. And coming back, how long does it take?
It's faster.
4 hours.
It's faster. Do you know why?
Jet stream.
The wind.
Exactly. Because of the winds. So when you fly out to California, you're flying into a headwind. We are flying into these financial headwinds called wealth eroding factors. There are things such as planned obsolescence. We all need new roofs, new cars, propensity to consume. The more we make, the more we spend. Taxes, lost opportunity cost on taxes, inflation, technological change. So these work against us at a rate of 10 to 12%, we'll say, like a headwind. So we need to save 15% just to keep even. This 15% should go into something called a wealth coordination account. So this is an account strictly dedicated to building wealth. We want to build a wall between lifestyle and building wealth. This account is also going to allow us to illustrate taxes, measure results, and facilitate the easy movement of money between all these different areas. So if you think of the heart in your body, the heart kind of pumps blood throughout your body and then back into the heart again. This account is going to pump money to different areas of the model and then back into this account. So it's kind of the heart of the model. Everybody with me so far?
Yep. And Jim, I mean, this model works really for anybody. Like if the income is $4,000 a month, right? We're talking about taking that 4,000, taking 15% from the top and learning how to live on the 85.
Exactly. Let me talk a little bit further about that. So our job is not to tell you to change your lifestyle. Because quite frankly, we believe money only has a value if you can spend and enjoy it.
Thank you.
But I want you to think of kind of like trying to fill up a bucket and there's holes in the bucket. And you could continue to pour water in the bucket and have the leaks come out and just try to pour more and more water, or you can plug up the holes. So what we try and do is plug up the holes, make your money more efficient, and then give that money back to you until you get to this 15%.
Mhm.
The first place we're going to move it to is somewhere liquid. You would be surprised how many clients I see that have no liquidity. There's a couple of reasons for having liquidity. Number one is obvious, as an emergency fund. And by the way, we want to see you have a minimum of 50% of your gross annual income liquid. So again, if you're making 200,000, we want to see a minimum of 100,000 liquid. Besides the emergency fund, it gives stability to the growth portion of the model. In other words, it allows us to take risk in other areas. It helps maintain our lifestyle, helps us avoid taking on bad debt. But in addition, it's there for opportunities. I have a lot of clients say, well, look, I want to move this money out of a money market because, I can get 5-6% somewhere else. But think of it this way. I'll tell you a personal story. 2008, the market crashes, the real estate market crashes. The middle of 2009, towards the end, I was introduced to a network out in Arizona. And the rental properties out there dropped, 40 to 50%. And we were able to go in and buy some rental properties. It was all cash buyers. Forget about getting a mortgage, forget about financing. It was all cash buyers. So how could you possibly measure that rate of return? By having the proper liquidity to be able to take advantage of that. So again, we want 50% liquid for opportunities as well. Everybody got that?
Mm-hmm.
Now, one thing we're going to do.
So that would mean, Jim, that, you definitely advise people to have multiple bank accounts so that they can manage their money properly, correct?
It doesn't have to be multiple bank accounts. We want to have one central account where we're not paying any bills, it's just building wealth. And that could be just a basic checking money market. And then that money is going to get moved into other areas. So that could be, for example, a money market fund, just somewhere where it's liquid. It could also be cash value of life insurance, for example, because that has liquidity. So we're not worried about the rate of return on that particular portion. We just want liquidity.
Okay.
One thing we're going to do is we are going to move the interest out, as opposed to letting that money compound, which is probably a little bit different than what you've been taught. So I was always taught that, compounding is great. And look, you could put your money in there in 20, 30 years. Look at all this compounding. And what we're talking about, by the way, is your liquid account. So this is money outside of some sort of tax shelter.
Mm-hmm.
So I want you to look at these columns here. And let's just say we had 200,000. Let's say it was a tremendous bank. We're great customers and they're giving us 7% interest.
7%.
What?
Where?
Exactly. Well, by the way, this also applies to mutual funds, brokerage accounts that you may have stocks, bonds. It's taxed a little bit differently, but the same concept applies. And what most people do is they look at their statement and they're looking at this end of year value. And they're looking at their money growing, and that looks great. But here's what's actually happening. Year one, you're getting 14,000 interest. You get a 1099 for that. So if you're in a 35% tax bracket, you're paying $4,900 in tax. Year number two, you can see the interest that you earned. You can see the tax. So what's happening to the tax each year?
Going up.
Does anybody know what rate it's going up by?
7% at a compound interest. 35% of 7%.
Yeah. So the tax is actually going up by whatever you're getting on the account. So if you found an even better bank that gives you 10%, you think that's great. But what's really happening then is your tax liability is compounding at 10%. So what we do is we move this interest out and put it somewhere more tax efficient. Then what happens is in year two, you have an additional $343 to invest. In year three, you have an additional $710. So you can see in these columns to the right how much of a difference that makes. So that's why we move the interest out.
And you move the interest out and you put it in what?
We put it somewhere tax efficient. It could be a variety of different places. It may be a Roth. It may be real estate, for example. I could move this 14,000 interest out and offset maybe the mortgage payment on real estate. And my property, when it grows, am I paying taxes as that property's growing?
Yeah.
No, because as it's growing each year, unless I sell it, that is really growing tax deferred. So as that property's growing, I'm not paying any taxes on that. But either way, what's happening is when we move the interest out, we're able to save money each year and do something with that as well. Most people don't realize this is actually happening because they get their 1099, they give it to their accountant, and all they really know is they owe or they're getting money back, one or the other. After we have liquidity, we're moving the interest out, again, back into this wealth coordination account. then we may consider putting money into a qualified plan, which we're going to talk about. We would suggest only up to the match. Does anybody have a SEP, a regular IRA, 401k, anything like that?
Yep.
Yeah.
And what is it that you like about it?
I don't even know. How about that?
Other than everybody tells you should do it, right?
It got set up a while ago and I need to actually see what it's even doing.
So I hear a variety of different things that clients like. They like that it's pre-tax. They like the tax deferral as it's growing. They're not paying any taxes on it. But I wanted to kind of delve into that. I've heard accountants say that if I put $10,000 into a qualified plan and I'm in a 30% tax bracket, that's saving me $3,000 in taxes, and I could take that $3,000 and I can invest it somewhere. And I want to kind of take a look at that. So here we have 3 different people. Let's say this person's making $250,000 a year. They're putting away $40,000 in a qualified plan. The rest of their itemized deductions are $50,000. So their taxable income is $160,000. So they're only paying $56,000 in taxes. After taxes, they have $104,000 left over. Make sense?
Mm-hmm. Got it.
So if their lifestyle was $104,000, meaning they spent this whole entire $104,000, how much money do they have left?
Zero.
Right, zero. So where is that tax savings really?
What do you mean? Where's that tax saving?
Well, you could see this person didn't put money in a qualified plan, so they paid $70,000 in taxes.
Oh, right.
This person did, they paid $56,000. So I've heard accountants say there's $14,000 that I could take and do something with. And what I'm saying is that's not true. Because if you spend $104,000, which is the money you have left over, you don't have $14,000 to spend. What's really happening is that tax savings is actually inside the plan. So really what's happening is you're putting in $26,000, Uncle Sam's matching it with $14,000, and it's growing inside that IRA or that SEP or that 401k. Whatever your tax bracket is in the future is the rate that Uncle Sam's getting on those taxes. Does that make sense?
Mm-hmm.
Yeah.
Think of it this way. If you have 2 farmers, Farmer A and Farmer B, and Farmer A buys the taxes, tax-free, plants the seeds, big successful harvest, sells the harvest, pays tax on the entire harvest. Farmer B,
The forests.
Yes.
whatever it is.
Yeah.
Farmer B buys the seeds, pays the taxes on the seeds, plants them, same thing. Big successful harvest, sells it, tax-free. Which farmer would you rather be?
I don't know. That was the question we had when you went dark on us.
Yeah. Can I ask Jim a question?
Yeah.
Sure.
Hey, Jim, I've heard from, that question came up, and a financial planner who I ran that by gave me, I told him the same story because I'd heard that. And he said to me, absolutely not. And he went into a very long explanation of why you would want to do the first thing, which is get a tax deferred. And here's a guy that has over $1 billion under management. So I'm kind of like saying, well, kind of knows what he's doing. So, all right. So I guess you were going to give us your opinion of that.
It's not an opinion. I could prove it.
Okay.
I could actually prove it with calculators, and that's kind of what this is showing. So really what it comes down to is what your tax bracket is going to be in the future,
Yes.
Right.
if that makes sense.
Yep.
Did
Yeah,
he
'cause
talk
you
about
could be
that?
he did not. You're right, but you could be at 40-50% now tax bracket, but then when you retire, you could be, on basically
20.
retired having, you could be at 28, right? So, yeah, I see what you mean. Mhm.
And what I'm saying is, why would you want to work your entire life, be successful, save your money, and be in a lower tax bracket when you retire? Why would you want to have less income? I can assure you that the clients that work with me are not going to have less income at retirement. Does that make sense?
So you are for qualified plans or not for qualified plans?
In most cases, I am against it, except when you're getting a match from an employer, because my thoughts are, if you're successful, you're going to have income at retirement. Let me ask you this. If you went back to this same advisor and you said, okay, I took your advice and I have $7 million in my qualified plan and I want to pull it out and I want to spend and enjoy it, what do you think he's going to tell you? Ask him.
Yeah.
What do you think he would tell you?
Don't do it.
Why not?
You got to pay tax on.
Right. So I only want to spend a little bit of time, or a little bit at a time, because I don't want to pay taxes on it. So think about this for a second. You've saved that money. You've given up use and enjoyment of it for the past, whatever, 20, 30 years. And you go to actually spend your own money. And the same advisors that told you to do it are now telling you don't do it because you don't want to pay taxes on it. That never made sense to me. It's like buying a castle and being locked out of your own castle.
Mm.
To simplify it, again, it's kind of a personal choice, but I could prove the math at another time with you with calculators. Think of it this way. Who controls the amount of money you could put into a qualified plan?
Government.
Government.
Mhm.
Who controls how long it has to sit there?
How long it has to sit there?
You.
Yeah.
No, if you take it out before you're 59 and a half, there's a 10% penalty.
Oh,
Yep.
okay. Well,
Mhm.
mhm.
Who controls when you have to take it out?
Government.
And when you finally take it out, who controls what the tax rates are in the future?
Government.
Mhm.
So how do you feel putting your money somewhere where the government has that much control over it?
Mm.
Well, the only thing would be is that you save, if I have $10,000 to put in that, I don't have to pay taxes that year on the $10,000.
Right.
So that's attractive in a way.
Mhm.
Well, but here's the thing, and that's what I was trying to show you with this point right here. That money that you're saving isn't in your pocket. It's actually inside the plan. So whatever rate of return you're getting on that contribution that you made, Uncle Sam is getting on their tax dollars. Does that make sense?
Well, it's going over my head, but okay.
We can sit down another time and I can go into detail how it works.
Okay.
But think of it this way. If you put 40,000 in, right?
Mhm.
And you're saving, this is somebody over here in this right column that does not contribute.
Okay.
So there's 14,000 of tax savings, right? This is how much they have left over, $104,000 after they pay the tax. If they spent that whole $104,000, how much money do they have in their pocket?
Zero.
Zero. If this person spent the 104, how much money do they have left over?
26,000.
Right. Which is right here. So what I'm saying is this person putting in 40,000 into a qualified plan is the same as somebody putting in 26,000 in a Roth after taxes when they pull the money out. It's the same thing, assuming tax rates are the same in the future.
But now they're talking about taxing Ross and all the others.
And yeah, they've been doing that. There used to be a 50% when I came into the business. There was a 50% excise tax on excess accumulations in a qualified plan, which is kind of my point with locking up your money that the government controls. If you did a great job of saving money and you got a tremendous rate of return and you saved $10 million inside a 401k, and Uncle Sam decided the day before you retire, we're going to increase income taxes to 90%. Number one, can they do that?
Yeah, of course.
Yeah.
Absolutely.
Yeah.
So then how much is that $10 million worth?
Whatever they say it is.
Yeah.
Exactly. And they control that. This is kind of the history of the highest US marginal tax rates. And you can see for this period of time that the marginal tax rates are over 90%.
How was that even possible?
Because it's the government.
No, it was also possible because there were so many tax loopholes and write-offs that even though it was like 90%, you had a lot of ways of kind of getting around it.
But that was still the marginal tax brackets. And yeah,
Yes.
there were other deductions.
Yeah.
Some of them they eliminated. They've installed more deductions. So it varies. But I guess what I'm trying to point out is this is the government and they control that. You don't.
Is that the government trying to recover from the Great Depression?
Yeah, I mean, I have a whole chart and it shows you what was going on in history.
Okay, that's
And
a
World
kind of
War II.
insane to go from 25% all the way up to almost 100% of your income being taxed.
And that's why in the 80s, which is when I grew up, I can remember Ronald Reagan talking about lowering marginal tax brackets and him saying, it's not worth it for me to work because if I make more money, I'm actually taking less money home.
That's right. That was part of the conversation then. That's right.
Yeah.
So they lowered the tax rates. And I guess what I'm saying is if you think about where we are as a country and what's happening, you know, who knows what's going to happen to tax rates? We really don't know.
Well, Jim, this is a really big eye opener because when you talk about like what will the taxes be in 30 years from now, when I'm, you know, definitely retired, I don't know. I never thought that the tax rates would go higher than 50%, but I didn't know the history of it. So now knowing this, I would be more apt to go like, well, I know what I know now. I know what the taxes are right now. I probably would do the qualified. Right? Qualified or non-qualified?
Probably a Roth, meaning if they
Roth.
go higher in the future.
Right.
And if you do put money in a qualified plan, the whole point is having a strategy to get your money out, other than to keep deferring it to a later date.
Yep.
Yeah. So I just want everybody, I mean, because Jim, we're going to have you for a couple more sessions also. But I want everybody to understand the importance of wrapping your head around these conversations, because as we are working physically every day, counting hours, creating schedules for ourselves, are we working towards a plan of the life that we're designing, or are we just going to be tied to this work for the rest of our lives? There's a lot of thought that goes into this as to what I earn. What do I do with the money that I've worked for that I earn while I'm earning it so that I can have a plan?
Yeah, we can get into we could do a whole thing on maybe we'll do that sometime. Qualified plans versus Ross, potential exit strategies. Should you have real estate inside an IRA or shouldn't you?
Yeah.
All kinds of complex discussions. I kind of got off track a little bit there, but this is just a general allocation. So if we may decide to put money in a qualified plan or Roth, we may not. After that, our money's going to go into different areas such as bonds, perhaps stocks, and then hard assets such as real estate and businesses. And we're going to kind of balance this and diversify it. All the interest, dividends, positive cash flow from real estate, and our brokerage account is going to go back into this wealth coordination account. Let me just make it a point too, since you guys are real estate agents. If I buy a house, let's just say it's an investment, and I pay $250,000 for it.
Not on here.
Yeah, I know.
He's in Pennsylvania.
Well, not around here either, believe me.
Yeah, I know.
So let's just say 500,000. How's that? And it now grows 15 years later to $1 million.
Appreciates.
Have I paid any tax on that growth up to this point?
No. Nope.
Okay, that's tax deferral. The same thing that people were talking about with qualified plans, that's tax deferral. And when I sell that property, what type of tax do I pay?
Capital gains.
Absolutely. And when I pull money out of a qualified plan, what type of tax do I pay?
Capital gains.
Capital gains.
No, ordinary income tax.
Oh,
So money
Oh.
coming out of a 401k is ordinary income tax. I sell a property in the future, I pay capital gains tax. In most cases, which is less? Capital gains tax.
yeah.
So just something to consider. There's other places to get tax deferral.
Okay.
So when it's all said and done, this model should look like this. 15% of your income is going into this wealth coordination account.
Okay.
The first place that money is being moved to is somewhere liquid. We're going to move the interest out back into this wealth coordination account. Once we have our liquidity, we may or may not go into some sort of qualified plan. Then money's getting moved into bonds, stocks, maybe traditional asset classes. And then into the third level, maybe collectibles, real estate, tax shelters, maybe real estate syndications, private equity, oil and gas partnerships, non-traditional asset classes. Any income from these assets gets moved back into the wealth coordination account. So your money is constantly moving. If you allocate like this, you're going to have many different sources of income as opposed to the traditional Social Security and money from 401ks. You have the potential, maybe Social Security if it's there, potential for trust income, maybe dividends and life insurance withdrawals. The ability to not just take interest, but to spend down your money, which is important, without the fear of running out. Any money in qualified plans, to be able to take that on a single life basis, as opposed to a joint life. Money that's in a portfolio, again, being able to spend it down as opposed to just take interest from it. Income from real estate income, different passive income streams from different businesses, again, real estate syndications, other type of alternative class investments. So that's really what it should look like. I want you to think of it this way. Does anybody here play golf?
Mhm.
Nobody plays golf?
I don't. I think Hal does.
How about tennis?
Totally not me.
Well, think of it this way. We'll just use golf as an easy example. If you went out and you bought the best clubs money could buy, how many strokes do you think that would take off your game?
Couple.
Maybe a couple. But what if you took lessons with Tiger Woods and you practiced every single day and you worked on your swing? That's going to take a lot of strokes off your game. And the point is this: it is not the products or the clubs. They're important, but that's not what really helps you build wealth. It is the process and the strategies that you use that help you build wealth. If you think of this as like a golf course, the idea is to keep the ball moving around the course and to not let it go outside the course or go out of bounds. And the more times it does that, the more wealth you're going to build.
Love it.
Any questions?
Can I ask you, I have a question, Jim?
Sure.
Just getting back to the basics, should every real estate agent, including the ones in this call, should we all have our own LLC or S Corp and have our money go into that and then pay ourselves a salary?
So I would say that it probably makes sense to have an LLC. LLCs could be taxed in different manners, such as an S Corp election. I would say that really depends on the agent and the amount of income, because there are some additional filings, but it absolutely could make sense to do that. Every case is going to vary though.
And that's where in the beginning when you were talking, and I'm sorry, because we have to go to finish up for 2:00, but we do have you coming back a couple more times. But that's where we were talking about how you are overseeing all of those conversations that we would be having, because each of those parts of our wealth building decisions will affect the other.
Exactly. Coordination, you know, I'll one quick example on that. You may have your wealth advisor that tells you to put money in a qualified plan because you're getting some sort of tax savings. And that may make sense. You may have your mortgage broker tell you to do a 15-year mortgage or to prepay your mortgage because you're saving on all that interest. And that strategy may make sense. But when we look at these two strategies together in a macroeconomic world, which is where we really live, one strategy, you're getting a tax savings, the other one, you're giving up a tax savings. They're canceling each other out. And our job is to make sure that that doesn't happen.
So then what do you do if they cancel each other out?
Well, your objective may be to prepay your mortgage, but there might be a better way to do it other than give it directly to the bank.
Okay. How else can you prepay the mortgage unless you pay the bank?
Well, there's other ways to do it, but
Okay.
we can get into all these discussions at another time. But
Okay.
Jim and Kevin, I will connect you guys. I definitely think it's worth having that conversation. And Jim, if you could just kind of finish up so that we could finish up for 2.
That's it. I'm good.
All right. Well, let's take you off screen for a second so we could ask, does anybody have any specific questions about what Jim just talked about today? Daniel, you got a question there?
Excuse me. Just Jim, obviously you're in Pennsylvania. You're versed in New Jersey and New York State. Just curious.
Yes.
Does that matter?
Really all over the country.
Yeah. Okay. I love what you said. Thank you so much. Yeah.
Thank you. I appreciate that.
Yeah, I appreciate you. Thanks.
Harleen, I see that you have your hand up, but you're also muted. If you could unmute.
Hi, Jim. Hi, everyone. Thank you, Jim. This is great. Very informative. I just wanted to ask you quickly, as a new agent who's not you know, sort of making any money at the moment, but I would like to invest. Can you recommend something in specific that someone like myself who's brand new to this field can do, as far as maybe I've like the idea of investment, you know, in real estate? Anything in specific you could recommend?
Again, this model, which I'll get out to you guys if you want. First thing you should do, 50% of your income liquid. I know it's not exciting, but
Okay.
50% liquid.
Okay.
Thank you. I appreciate that answer, even though it's not always the answer we want to hear.
Yeah.
We do need to build those reserves. And even in any business, we're building 6 to 9 months reserves. And that's basically, you know, we're talking about the income coming in. Jim, I love what you said in the beginning, is it kind of gives you peace of mind that you can make some decisions. You have options because that cash is sitting there.
And honestly, you guys have tremendous opportunity being with Keller Williams. I mean, truly, you know, what if you get the opportunity to invest in title? What if you get the opportunity to invest in the insurance company or the office? You have avenues I don't have, you know, where you could buy shares and get income from that.
You can always get your license.
I think what you said is a really great example, though. We have opportunities that are just cash deals that are in front of us, and some of us can't make the move on it because we don't have the liquid. And we are in that market that some properties cash is going to be, you know, what takes the contract. So, Liz Crespo, did you have a question? So you trying to unmute yourself. Kevin, go ahead. You ask your question.
Oh, no, I don't have another question. No.
You just want to say hi. Okay. Jim, we have you coming back again in April 2 times. So we'll go ahead and get those dates out, or is it April and then May, I believe?
Great.
And is there a way that they can reach out to you, or your company to learn more?
Yeah, if you want to give us the emails of everybody that was on, I will forward this model to everybody.
Perfect.
And then they'll have the email, my assistants, and then they could just reach out whenever they'd like.
Perfect. Okay, perfect. I will go ahead and do that for you. Absolutely. All right, guys. Jim, I want to thank you for your time. Thank you guys for being a little patient in the beginning. We'll be back again with another conversation with Jim Mammarella, and we're going to keep having him come back because this isn't a one-time conversation. I hope this has expanded us a little bit to maybe go back and do a little deep dive. Maybe there's a conversation that needs to be had with our spouse, or maybe even just ourselves, as to, do we even have a plan? I love the advice of just, let's get that 50% of our income liquid, so we all could be working on that this year, if you don't already have that. And Jim, thank you for your time.
Thank you. I really appreciate the opportunity.
Yeah.
It was great being here.
And I know that they're going to totally benefit from the future conversations that we have as well. As my husband and I did love our hour that we spent with you to just understand what our strategy would be. Jim said it before, it may be a strategy, but it just may not be the strategy that's best for you. So everything is specific to what your goals are and what your financial situation is. All right.
Great. Thank you, Marybeth.
All right, guys. Thank you so
much.
much. We'll see you next month.
Have a great day.
Bye, guys.